Hello and good afternoon. Thank you so much for joining us today. My name is Samantha. I am here in client services at the retirement group, and I'm going to be moderating this webinar this afternoon. You're going to see me throw some useful links into the chat throughout the presentation. They will direct you to our retirement guide, as well as a link to book an appointment with an advisor after this webinar. Today, our speaker is Wesley Boudreaux, and he's going to be speaking to you about some tax strategies you might not be aware of that could potentially lessen your tax burden, as well as help you save a little more in your retirement. Before I bring Wesley on, I have to just make you aware that although we work extensively with both retired and active members of Fortune 500 companies, we are not affiliated nor endorsed by any specific company. The retirement group is a completely independent group of financial advisors. And after Wesley's presentation, I'll be coming back on with him to go over any questions that you may have asked during the webinar. There's a Q&A box down at the bottom of the screen. You can feel free to enter any questions you might have. They are completely anonymous, and Wesley will try to answer as many as possible before the end of the presentation. And with that, I'm going to just bring on Wesley. Wesley?
All right, thanks. Appreciate that introduction, Sam. And like she said, we're going to be talking about tax planning strategies, kind of how it affects a lot of the employees and retirees we work with at Fortune 500 companies, helping them understand the transition process and different ways to actually minimize taxes throughout retirement. And like she said, even though we work extensively with a lot of them, we're not endorsed by your specific company. But for those of you who don't remember or haven't talked to us before, the retirement group, we are an independent financial advisory firm that, like I said, focus on working with corporate employees, helping them transition into retirement. We've been doing this for a little bit over 30 years. So some of those relationships with companies go back over 30 years, and some of them maybe 15, 20 years. But what that allows our advisors to do is have a deeper focus and understand of your specific company plans, so we can help you through that transition process, whether it be questions on the pension plan, the 401k, healthcare retiree medical benefits, life insurance, how that transitions, all those different items that you have questions on that you might get a run around through HR. Give us a call. We can kind of run through that with you pretty quickly and ultimately kind of drive that into how does this going to look for me as I transition to retirement? What's the next 20, 30 years going to look like? And that's one of the best things to take us up on, actually, is our complementary cash flow analysis. This is a way for us to actually run a financial plan for you, structured specifically to show you how your company plans work and what's it going to look like as far as your decision process for the next 20 or 30 years, not just how does it look right now, but if you want to review, okay, should I retire this year versus work another 2 years? Should I take a pension as a lump sum versus annuity, split it? What are all these different options and how they play out over time? Now, we do all start the country, so rest assured, if you sit down with one of us face to face, we can probably still accommodate that, but obviously, this day and age, it's very easy to do a web meeting or a phone call or email, whatever your preferred communication is. Just go ahead and let us know. And there's a QR code up here. We'll bring it back up at the end of the webinar too, if you'd like to go ahead and follow us on our LinkedIn page and get company-specific information on your company plans as well. So before we kind of get into some of the tax strategies, let's go ahead and give a quick recap on what's been happening the last couple of years. There's been a couple major tax changes. Back in December 2019, they signed in the Secure Act, which took place 2020. We'll go over some of those. And they also just recently signed in Secure Act 2.0, which goes into effect here in 2023. So some updates and some changes to that original Secure Act. We'll go through all those. One of the first and most beneficial changes we saw from this, the Secure Act, it used to be that you had an RMD, a required minimum distribution at age 70 and a half. So what that meant is that you can save all you want, but eventually the IRS is going to come knock on the door and say, hey, we want to tax this money. We want to get some revenue off of this. So we're going to force you to start taking distributions at 70 and a half. Now that was changed to 72 starting in 2020. And here in 2023, it's been bumped back again to 73. And then for those of you that are younger, in 2033, they're going to bump it again to age 75. So essentially, if you were born after 1951, right now you're looking at age 73 for your RMD. If you're born after 1960, that's going to be age 75. But again, you're a couple years out from there. You're not going to hit that till about 10 years out in 2033 or so. Now, the benefit here is, again, this allows you to defer your taxes longer if you want to. We'll talk a little bit later about whether or not it makes sense to defer everything, because if you keep deferring everything, it's going to compound that your balance sheet, and it's going to compound the amount you're going to have to take out for that RMD. And I think it's a safe argument to say I think we're in pretty favorable tax brackets right now, and in the next, 5, 10, 15, 20 years, they'll likely be higher. So you may not want to stockpile too much in that RMD, but what it does, it gives you more years to plan, which we'll talk about that in Roth conversions ahead. Another big negative change in this case was actually the elimination of the stretch IRA. It used to be that if you were to pass away and let's say leave your beneficiary other than your spouse still has a stretch IRA option. He or she can move it to their own IRA. But it used to be that let's say you left it to your kids or a cousin or uncle or whoever it may be, they could actually take those distributions out over the course of their lifespan versus having to take it all out at once. The new rule gives them a 10-year window where it has to all come out within those 10 years. Unfortunately, I went through this with two different clients as early as January 2020. So when this thing first got enacted, one was a divorcee, and so he had his kids as the beneficiaries. So it went to them. Instead of them being able to stretch that over their life, now they have to take that out within a 10-year period. So if we're trying to minimize taxes, best we can do roughly is just kind of taking out 1/10 a year to kind of minimize that. So there's definitely some tax planning strategies around this, even if you have your spouse as a beneficiary. Hopefully the goal is that, let's say, for instance, myself, I'm probably going to pass before my wife and then pass things under her, and then she'll pass and then pass the residuals down to our kids. So eventually there is a non-spouse beneficiary probably in that line of your retirement planning. So it's important to kind of be aware of this because, unfortunately, if we pass away, hopefully our kids are, older in their 50s, maybe 60s or so by that point. But they may be working and have a good paying job. So if they have to take more out on top of that, it could drive up their tax bracket as well. A positive change. They actually did away with the age restrictions for contributions. Used to be once you hit RMD, excuse me, used to be once you hit RMD level at 70 and a half, you were forced to stop making contributions. Now you don't have to. So you can be 80 or 99 years old. You can be working at a hardware store, working at Walmart, doing whatever you want to do. As long as you have earned income, you can still make contributions to an IRA or a Roth IRA if you want to. So that, again, is a good benefit for you going forward. So let's talk a little bit about the tax brackets. And I'll give you the 2022 brackets, which we're just coming off of, and the 2023 brackets. I'm not going to expect you to kind of dig in here and understand all or know all this in this chart. But what I will focus on is let's look at the 12% tax bracket, because one of the biggest jumps is that 12% to 22%. It's a 10% jump. So I'm going to zoom in here and make it a little bit easier to see. But if we look at the second column, the married individuals filing joint returns, the top of that 12% tax bracket goes up to $83,550. And the very bottom of this chart, under that same column, you'll see that the standard deduction is actually $25,900. So you add these together, that's a little bit over $109,000 as far as the top of the 12% tax bracket if you don't itemize. And a lot of people aren't itemizing anymore because of those sizable standard deductions. So what that means is somebody that's bringing in under $109,000 is going to be in that 12% tax bracket. But if they, let's say they bring in $120,000, that extra $11,000 is going to bump up into the 22% tax bracket. So it's really important to use this for tax planning strategies. We mentioned again the RMD being stretched out longer between 59.5 or between retirement and 73. You've got years where you can plan Roth conversions if it's beneficial for you. So in some cases, we got individuals that are converting, at the 22, 24% tax bracket. But if you're in the 12% tax bracket, it's almost a no-brainer for a lot of you. In which case, so for instance, let's say you are only needing $70,000 to live on, then that means you've got another $39,000 or so before you hit that 22% tax bracket. So we would argue potentially that take $30,000, $35,000, convert that over to a Roth IRA at 12% tax bracket, so it reduces your RMD down the road in the future and reduces your potential taxes for yourself or your beneficiaries. So these are all things that are actually kind of a one-on-one conversation to go over with you when it comes to planning, but I just wanted to make you aware of that. And then at the bottom here, we've got the long-term capital gains, which are either 0, 15, or 20%. A lot of this comes into conversations with our individuals that have NUA options, where they've got company stock in their 401k as well. This is really just the same thing. It's just that the brackets haven't changed. It's just been kind of adjusted for inflation. We've got a pretty good kick in this case. If we focus back on what I was talking about before, the 12% for a married couple as an example, if you looked at the standard deduction in that, it was up to about 109,000. Now, if you add the two together, it's up a little bit over 117,000. So almost about an $8,000 change or bump in the taxes for this year, 2023. And again, it's really important to understand these are year by year calculations, because administrations change and tax brackets change. So again, when we run this cash flow analysis or talking about tax planning strategies, we'll be focused on that year by year. Now, whenever you do retire, the big question is, and a lot of people don't think about this, where are you living? We work with a lot of people all across America, and we work with a lot of people that have retired from one state and maybe moved to another state. Let's take California, for instance. We work with a lot of people in California. Obviously, a pretty high income tax state. On top of your regular income taxes, you've got high taxes for state income tax. And it may be that you retire and say, I'm tired of paying this. I want to stretch my dollar farther besides just the, things being cheaper in other states. Sometimes it's going to save you in taxes. Maybe you want to move to Nevada, or you move to Texas, or move somewhere where there's actually no state income tax. That could be a big change. We can actually run those numbers side by side. Say, okay, hey, if I retire and stay in New York for the next 30 years versus if I move down to Florida, how much the difference going to be? And you can see it could be, thousands, if not over $100,000 difference, or it may be able to stretch your plan longer, allow you to pass more money on to beneficiaries. So if you're contemplating this, just let us know. And it gets a little bit dicey, because a lot of states may have state income tax, but they maybe don't tax pensions, or they don't tax IRAs. Maybe some tax IRAs and some don't tax pensions, don't tax Social Security. There's a lot of different nuances from state to state. So if you let us know where you plan on residing, and we can run those calculations for you as well. Just to kind of piggyback and finish up on the Secure Act, I've mentioned some of the main ones, but some of the new changes here for the Secure 2.0 that just took place here for 2023 are, again, we just talked about later RMDs, a reduction in the penalties, which is a good thing if you miss your RMD. Excuse me. They're eliminating the RMDs for Roth 401ks, which is good, whereas it used to be, used to be in the past that if you had a Roth 401k, which is great, you need to roll that over to a Roth IRA, because at 70.5 or now 72, then 73, you were forced to take an RMD. That's gone away. So that's something that's good. They bumped up the different income limits and things, and some of the contribution limits as well. There's a potential Roth matching option where your employer can make Roth contributions as a match. Now, since that's into a Roth, you're going to pay taxes on those versus the tax deferred. Different options, like where if you've had a 529 plan and maybe you've your kids have outgrown it, or you don't want to give to the grandkids, you got something in there, you can actually roll a portion up to $30,000 over to a Roth IRA, and some other different changes. But ultimately speaking, a lot of things that kind of make the 401ks more accessible to people as well. So let's get into some of the tax planning. We'll talk about inflation, talk about the distribution methods in which you need to look at, and some different options when you do leave a company, how to treat your pension versus 401k as well. First and foremost, inflation's pretty ugly. We've seen this, in 2022. We talked about it for the years leading up to it, especially post-pandemic. We saw the interest rates go very low. We knew they had to come back and swing higher. They swung a little bit higher and quicker than we actually expected, but you got to be careful when it comes time for planning and focus on inflation. And again, we can get into detail, but there's two different inflation numbers. There's the CPIU, which is going to be your classic inflation number. But then there's also your inflation number. You may not have spend much on housing. You may not travel as much. You may not drink and smoke. There's a lot of different things that go into these. So it's really important to understand what your actual inflationary pressure is, because that does factor into the long-term planning aspect. And when we run that cash flow analysis I mentioned before, we do so from a conservative standpoint. We assume lower average rates return. We assume perpetual higher inflation. So when we're said and done, if we're going to tell you you're on the right path, then we're going to be pretty sure about that. So again, planning for the worst, hoping for the best kind of situation. We don't want to go out there and tell you that everything's, hunky-dory and, the markets are returning 10% and inflation's low. That's going to make things look better than what they may be in reality. We prefer to actually kind of plan more conservatively for you. So let's talk about the, whenever you leave a company, what your options are with your plans. Now, a lot of the companies we work with do have a pension plan. Not everyone does. And not every pension plan has a lump sum option. But if you do have a lump sum option on your pension plan, you decide to take that, give us a call to review that, because it's something to review based upon interest rates having changed. It may or may not be as favorable as you think. So we can run that cash flow analysis to show you, again, the annuity versus lump sum side by side. But if you do have a lump sum, most 401k plans may let you roll that into your 401k plan. And or generally speaking, I'd say 90+% of the people we work with, especially if they're over 59.5, when they retire, they're going to look at rolling over that 401k and the pension lump sum into an IRA, because whether they're going to do it on their own or work with us or another firm, there's just a lot more flexibility and a lot more choices. Be very careful if you're talking with somebody and let's say you're retiring at 56, 57, 58, and that advisor says, hey, roll everything over to an IRA. That's probably not a fiduciary. They're probably not looking out for your best interest, because There is what's called an age 55 rule. I think we'll talk about this a little bit later. But if you retire before 59 and a half and after the year you turn 55, you can take penalty-free withdrawals from your 401k, but you can't do that from an IRA without jumping through some hoops. So be very careful about that. But that transition, taking your 401k and or your pension plan, moving over to an IRA, no taxes whatsoever on there. That's just, again, moving from one tax-deferred vehicle to another. You don't pay taxes until you physically take that money out of your account, out of that IRA. Another item that we do a lot of work with individuals is a way to kind of maximize the Roth strategies. A lot of you do have options for a after-tax contribution and or a Roth 401k within your 401k options. Now, every company is a little bit different and specific about their distribution options, how much you can take, what percentages and things like that, how much is pre-tax versus after-tax. But if you have them putting in after-tax, so a quick example, let's assume you make $100,000, do a 10% contribution. If you're putting in 10% pre-tax, that's going to make it look like your income's only $90,000 for the year. So you save taxes on that 10%, that 10,000 contribution. But eventually when you take it out, you're paying tax on that plus the growth on it. On the flip side, if you did after tax, you're putting that same $10,000 in, but you don't get that tax benefit right now. So you're paying taxes on your full $100,000 income. But fast forward, 5, 10, 15, 20 years down the road, if you take a withdrawal, that 10,000 you put in is tax-free. Just the earnings are taxable. Well, let's take that a step further. And let's assume that we want to take that 10,000, move that over to an IRA, a Roth IRA, so that now it continues to grow for however long you want that in there, but you want to keep it there, until at least 59 and a half, and let that grow. And what's going to happen is that's going to actually grow tax-free, assuming you keep it there for 5 years and 59 and a half. So instead of that 10,000, let's say doubling to 20 and having to pay taxes on it, it's going to be tax-free if you do that into a Roth IRA. So again, if you have a question on this, even if you haven't built up any after tax, give us a call. We can show you how to do this. It's really a great way to kind of circumvent some of the Roth IRA contribution limits, especially if you're a higher compensated employee. You may not even be able to make contributions to a Roth IRA, but this is a way you can actually do more and build up your Roth account, so you have more tax-free assets in retirement and less tax deferred that gets hit with the RMD. Whenever we talk about that distribution, let's go ahead and kind of go through some examples of taking money out once you've now retired, want to live off that. There's a couple different schools of thought, and to be honest with you, even the software we use and pretty much every software you use is going to stick with the same thing. They're going to assume that you want to defer your taxes as long as possible. You don't want to pay the IRS until you have to. So they're going to assume if you've got taxable accounts like cash savings or brokerage account or things like that, you're going to tap into that first. Then you'll tap into your tax deferred, which like your IRA or 401k, and then you'll tap into your tax-free, whether it be municipal bonds or Roth IRAs. And so this is kind of how it would play out. What would happen is you would actually, for the first couple of years, let's assume you spend down your cash or your savings. So you see that dark orange, the first couple of years, there's no taxes, the red line on the bottom, because you're taking out from your savings. Now we fast forward, now you're stuck with only your tax deferred vehicles. So your IRAs and 401ks. You may start Social Security at that time too. So between that and Social Security, there's taxation. That's where that red bar comes at the bottom. So you're paying tax on that until, let's say you run out of your IRA money and now you're just left with your tax-free accounts like your Roth IRA or your municipal bonds. Then you're not paying taxes there potentially if your Social Security is under a certain threshold. So if you look at this, that red bar at the bottom, the first couple of years, there's no taxes. The last couple of years, there's no taxes. But in the middle, you're paying taxes. And the question is, how much are you paying? Are you paying more than what you should be? One quick example would be if we look at those first 2 years, if we go back to the standard deductions we talked about being over 25,000 right now, I think it's 27,700 for a joint couple for 2023. That means you can take out $27,700 from your IRA tax-free. That's just not going to kick you into that next tax bracket. Now we do have to kind of review whether it bumps up your taxation on your Social Security and things like that. So that's why it's important to review these things with us versus doing it on your own. But a more appropriate strategy may be to spread that out and focus on it year by year as these tax brackets change. So if we look at that blue, the tax deferred, we can see in this first year, we're taking out some tax deferred. Maybe it'd be that 27,000 I mentioned, or maybe it's a little bit more because you're comfortable paying the 12% tax bracket. So you got that, plus maybe you're tapping into some of your cash and you're minimizing the taxes there. And that's going to stretch that cash farther. And then once Social Security kicks in, you may decide, okay, I want to take some, obviously I'm going to take Social Security. I want to take some from my IRAs and some from my Roth IRAs, some from my cash. So we can kind of manage that year by year because like I said before, tax brackets will change as administrations change. And so we got to kind of plan ahead. and ultimately want to minimize those taxes year by year. And then also, if you're looking to save for your beneficiaries for them down the road as well. So quick guidelines on there, kind of fill up your lower tax brackets with tax deferred investments. So again, matching that standard deduction at least. Be aware of the taxation on Social Security. Depending upon what your income is 0% of it 50% or 85% of your Social Security could be taxed. And in some cases, if you're spending very low and you start to take out more, then it could jeopardize the taxation of your Social Security. So it's important to kind of review that. And then strategically utilize those tax exempt vehicles, whether it be municipal bonds or Roth IRAs. And that goes back to, again, the Roth conversion strategies we mentioned of building up those IRAs, those Roth IRAs prior to the RMD level. So you have more flexibility in managing your taxes versus everything coming out and being stuck in whatever tax bracket the IRS has at that time of the year. So kind of a quick follow-up on some of these, the flexibility of withdrawals from your 401k or an IRA. I mentioned before, age 59.5 is the 10% penalty if you take withdrawal prior to that. There are some exceptions. The big one I mentioned before was age 55 from your 401k. So if you retire the year you turn 55 or later, you can take withdrawals from your 401k without that 10% penalty. Now, keep in mind, you're still under the restriction of the 401k. Some may give you one withdrawal per month. Some may only give you one per year. They also have the 20% withholding. Doesn't mean that's your taxes. It's just going to be withheld. So you do have to plan around that, but give us a call. We can run through these. There's also a 72T or substantial and equal periodic payment, which the IRS finally updated about a year ago with higher interest rates. This is a way for if you're under 55 or maybe you have money in your IRA, you're not 59.5 yet, and you want to take consistent withdrawals, you can set up a substantial and equal periodic payment so that as long as you do that for at least 5 years and or 59.5, whichever is longer, you're not going to have that 10% penalty. You have to stick to it. There's other options if it's medical expenses that are at a certain level, first-time home purchase, post-secondary education, some other changes to the Secure Act, disaster relief options, domestic violence, unfortunately. There are some different options to potentially tap into that without the 10% penalty. And then fast forward at 73, potentially 75 down the road is when you have to take that RMD. So between 59.5 or between retirement and 73, we kind of say are a little bit more freestyle years. You can take what you want when you want. You don't have that penalty to worry about. That's where we want to focus on those Roth conversions and planning strategies in order to minimize those IRA distributions you're forced to take at RMD age. So everything I went through, again, is kind of a high level general, but like I mentioned, a lot of the items we can kind of hone in on specifically with your situation. And the best way to do that's that cash flow analysis or financial plan I mentioned. Right now, about 3/4 of Americans over 50 don't even have a written plan. If you can spend about as little as maybe 5 minutes if you have all your ducks in a row, or 15 minutes to gather some information, different items like the 401k balance, how's your pension, Social Security estimates, date of birth, retirement desires, spending, things like that. We can put together that cash flow analysis. It gives about a week to run it. We'll get that back over to you. We'll set some time to go through that in detail so you can see where you are, and which in turn can help us determine the best day to retire for you, focus on your pension plan and your 401k, help you with the allocation changes if you need those. So really any retirement questions, just give us a call. We can go through that. And as I promised before, here's the couple QR codes. There's one if you want to schedule a meeting with myself or one of the other retirement group advisors. You can use that QR code to get into our calendars. If you need something last minute, just give us a call or email us. And there's also one to our LinkedIn page where you can follow us on LinkedIn, and then from there you can let us know your specific company, so you get our company specific information, so you're updated on what's going on in your company, interest rate changes, things like that, plan changes. And like I said before, just give us a call at 800-900-5867, and you can always reach us at info@theretirementgroup.com as well. So with that, I want to kind of wrap it up, but I think Sam, I'm assuming we had some questions come through there probably.
Yes, Wesley, we had quite a few questions come through. The first one is, what are the benefits of a Roth 401k to Roth IRA conversion? Okay.
There's a lot of different benefits in there. The first one most people will see is just the flexibility options you have in an IRA versus your 401k. Now, usually if it's a Roth 401k to a Roth IRA, that's not really a conversion. That's going to be a rollover from one to the other. Conversions are usually when you pay taxes, you convert pre-tax money over to a Roth IRA. So if you've got that 401k and you want to convert some of your pre-tax money, usually you can only do an in-plan conversion, but if you're an employee, but if you've left, then you can convert that to an IRA. But usually what we'll do is we'll roll over to the IRA first, then do the conversion because there's easier options. Again, that screen I showed you before with the after-tax options, if you've got that in there, that can be rolled over to a Roth IRA. So again, you can call it conversion or rollover, whichever you want to. But what would happen is, let's assume maybe you've got $30,000 of after tax in their cost basis. Maybe it's worth $50,000. What would happen is the growth of 20,000 would go to an IRA, so it stays tax deferred, and then the cost base at 30,000 would go to a Roth IRA, so it grows tax free, assuming you keep it there for the next 5 years and you're over 59 and a half by the time you tap into that. So there's a couple different options there, and again, it's going to be plan by plan as far as the specifics of what you can do in plan conversions versus out of plan conversions. So just give us a call. We'll be happy to let you know the options you have on your specific company plan.
Thank you. Second question, can I use a Roth conversion to help lower my RMDs?
Absolutely. I think we kind of talked about that in some of the slides, especially looking at the tax bracket issues and things of that nature, and the taxation of distributions in retirement. So what happens is, I think it's safe to argue that we'll probably see higher tax brackets somewhere down the road with all the government spending that's been happening for the last couple of years. So if you continue to stockpile and defer your taxes to have a larger RMD, then you could get hit harder on taxes, because once you have to take those out, it is what it is. There's no controlling it. So you may have Social Security, you may have a pension, then you have to start taking RMDs, and it may kick you up into a higher tax bracket. So if we look at this year by year and look at the Roth conversions, whether you want to do a huge conversion one year or space it out year by year, we can do that to minimize the amount that you're forced to take out as an RMD later on at 73 or 75, depending upon how old you are. And that's going to benefit not just you, but also your beneficiaries down the road as well. And we usually do those conversion reviews come closer to the end of the year, maybe the fall. That way we've got most of the year behind us. We have a better idea of what your tax bracket is, so we can factor in those strategies and what your tax bracket is going to be. Especially if you're in the 12%, I'd argue that's a pretty low tax bracket. It's a good option to use a Roth conversion on. But we usually wait till the end of the year in case there's any gotchas or surprises throughout the year, maybe big expenses you didn't think were coming up, because we don't want to do it early and then go back and have to pay more in taxes because there's no recharacterization changes anymore. They eliminate the ability to change that a couple years ago.
Okay, thank you. Number 3, can I use the NUA strategy to save on taxes after separating from service?
Absolutely. It's going to depend upon your company and if you actually have NUA in there. So NUA is net unrealized appreciation. This is actually a tax strategy for employees that have company stock in their plan, and it has a low cost basis. You may have company stock, but it may not have a low cost basis because of maybe you've traded it, or maybe the stocks run up and they use an average cost. Every company is different. A lot of them use an average cost, so there may not be much NUA capability. Some that maybe have older ESOP plans in there have a lower cost basis. Some companies do a line by line calculation, so they let you know exactly what every share the cost basis is, so you can pick and choose. Those are ones that give you a lot more NUA capabilities. But ultimately what it means is, instead of just paying income taxes on your distribution, you would actually pay income taxes on the cost basis of your stock, and then the growth on it, you don't pay taxes till you physically sell that, and you pay them at a long-term capital gains rate, which we showed you before is either 0, 15, or 20%. So usually there's going to be lower than what your ordinary income is. So it's usually going to save you 7% or more, depending upon how we structure this. But again, it's going to be case by case situation. If you've got a copy of your 401k statement, we can tell you if you've got NUA in there. But for a lot of you that have low cost basis stock, it is something that's beneficial. But again, it does mean having to pay taxes when you do that in order to take advantage of it. So it's taxes now, save more later, kind of like a Roth conversion would be. So it's important to review all the different options on there, because there's also triggering events and every company treats it differently. So again, just let us know, get us a copy of the statement. We can tell you one-on-one what your options are.
Okay, and one last one before we go. How do qualified charitable distributions affect my tax strategy?
Okay, so qualified charitable distributions are going to be essentially, instead of it's one way we talk about minimizing RMDs and minimizing taxes down the road. If you're charitably inclined, this does not mean that you're giving it to your spouse or kids. This is giving something to a 501c3. So instead of making cash donations or taking withdrawal and giving cash donations, you can actually just do a direct donation from your IRA. So maybe you've done a great job of saving and you don't need the RMD. You don't want to get hit with the taxes. Maybe you've got an RMD for $40,000. You may do a direct contribution to a charity of that $40,000, so it's not a taxable event for you. So it keeps your tax bracket lower. Now, on top of that, I'm not going to get into all the details here, but if you're charitably inclined, give us a call. We can go through other options, whether you want to set up a donor advised fund where you can actually make larger contributions in one year to get a better tax break, and then distribute those assets to charities over time, or maybe as a legacy. Maybe you want a combination. Maybe you want to give to charity, but you also want to benefit. You can do charitable remainder trust or a CRAT or other different options where you can make a donation to charity, but you're able to also get some residuals off of that. And those are a little bit more complicated, but again, something we can go over with you if you have any questions on that.
All right. That was
Any
the
more,
last,
Sam, you said, or was
that was the last one.
okay? So just a quick reminder again, everybody, if you have any questions, just simply give us a call at 1-800-900-5867. We'll be happy to help you out or answer those questions. Again, this is a general webinar. We work with a lot of different Fortune 500 companies, but that does not mean we're endorsed or employed by your individual company. But chances are, if you have any questions, we can definitely dig into those for you and help you out. So we thank you for joining us. We hope you have a great day.